This month's CRE recap theme is Recovery Interruptus, the unfortunate situation that has persisted for the past several years when seemingly signs of recovery are dashed by external factors. Last year was the Liberation Day tariffs, and this year was the Iran war, has once again raised the specter of higher or persistent inflation, preventing commercial mortgage rates from falling from the level of the past 4 years. So we sit at a place where, as of today, the 10-year Treasury rate is higher than it's been by a few basis points over the past 6 months and the past 12 months, and back to where we were last summer before things started getting better. Our just released proprietary data shows this recovery interruptus and what's going on in various guises. One, after showing potential signs of a market thaw at the end of 2025, investor preference to hold real estate versus buying or selling increased from 63 to 70% in the first quarter. This is underscored by transaction volume data that we've seen for February, which is down almost 20% to $30 billion, the lowest monthly volume since April 2024. Investors from Citus AMC Insight Survey are reporting that capital is becoming more disciplined and availability is decreasing slightly in the first quarter, exerting downward pressure on activity and workouts. And finally, amid escalating geopolitical tensions and their effects on interest rates, cash was the king in the first quarter. Preference for cash jumping to the most favored asset class. Preference for bonds also increased over the quarter, while after 3 quarters in the top spot, the preference for commercial real estate declined, tied with bonds for the number 2 ranking. Still high, but off, as investors note the impact of potentially, persistently higher interest rates. The situation in the Middle East has calmed down, but remains uncertain. Meanwhile, the commercial real estate is having another rough start of the year.